Good morning, good evening, good afternoon, depending on your time zone. Welcome to the paper presentation 6B. Rena, can you tell me if you can hear and see me?
Professor, please continue.
Great, excellent. Welcome to the paper presentation. We're going to talk about ESG. Does it matter to investors? Now, of course, that's a rhetorical question. ESG investing has been primarily driven by investors. And if you're coming to this conference, you probably are aware of the impact on investors of ESG. But I think today the research that we'll present asks a deeper and more nuanced question, which is, does it matter to small investors? Not the plutocratic squillionaires, the oligarchs, but the 99% that entrust their hard-earned savings to the financial ecosystem. Does ESG matter to those small investors? Broadly, our session is focused on new research that demonstrates that decentralized, non-institutional investors tend to allocate capital towards positive ESG issuers and low carbon issuers. And that leads to a consequent reduction in the cost of capital for ESG and low carbon issuers. What's interesting about the research being presented is that it uses the best available methods and also a variety of methods. There has not been as much academic research on this field as there ought to be, as pointed out by Ben Caldecott in the welcome video. And these researchers are very much looking at deep data to give us some nuanced conclusions. So I'm going to summarize briefly the 4 papers at a very high level and then ask each of the speakers to come on board. First of all, the first paper is by Gunnar from the University of Gießen. And he's going to show us that experimental evidence indicates that individual investors' preferences for sustainable development make them gravitate towards SRI, sustainable development focused, socially responsible funds. The second paper is by Yasid, who's currently at the University of Mannheim Business School. And he analyzes order level data, so market microstructure data, from Europe's largest retail investor exchange. He uses a difference in difference approach. And he concludes that corporate ESG behavior, corporate ESG ratings, influence the buy and sell decisions of retail investors. So anybody who tells you that small investors don't care about ESG, they only want profit, particularly short-term profit, that conclusion is blown out of the water by Yasid's work. And then third, we have Amir from Oxford, and he basically looks at a natural experiment which is generated by cross-country variation in the reporting frequencies within Europe. So between France, Belgium, Luxembourg, there are different reporting frequencies on sustainability disclosure. And that creates a quasi-natural experiment, which he exploits to look at the behavior of private wealth investors, particularly their allocation of capital within data provided by a private bank. And he looks at that capital allocation choice based on domicile. And his research indicates that investors direct an economically significant portion of their portfolio to assets with increasing sustainability ratings. And finally, we'll have Arjan, who is at CPV, the Netherlands Policy Institute, presenting a paper which shows, using cross-sectional regressions across about 2,000 issuers, indicating that carbon intensity is associated with the reduced cost of capital. And he suggests that might be linked to the factor of cyclical volatility. That is, high carbon intensity in an issuer is usually a signal of cyclical volatility in earnings. And so low carbon intensity is an indicator of higher value added, more consistent, sustainable earnings potential. Now, there is older work on the relationship between ESG broadly and the cost of capital, but Arjan's work shows that for carbon intensity, the conclusions are no different. So without further ado, I want to let the speakers present their research. And so I would invite initially Gunnar to present his paper on, with co-authors, on the determinants of individual investment behavior, a framed field experiment. What I would ask the audience, please feel free to contribute to the chat room or to ask questions in the Q&A. The speakers will be presenting from slides, but I do have the moderator's prerogative to jump in, especially if there are burning questions, and certainly we'll have time at the end to have questions. So please do ask questions in the Q&A. And with that, Gunnar, welcome. Thank you very much for joining us, and please go ahead.
So thanks for the very nice introduction. I hope you can see my screen because...
yes, I see it.
Yeah, I hope you can see this presentation. Yeah, so what we did, so it means this is joint work together with Heike Wetzel and Andreas Ziegler from the University of Kassel. We conducted a framed field experiment in order to analyze the determinants of individuals or retail investors in the case of sustainable investment behavior. And I'd like to briefly motivate our approach on this topic by going through some methods that enables us to reveal preferences for sustainable investments. And on the one hand, we could use purely market data, for example, in event study approaches, which allow us to analyze whether investors react to certain events, like, for example, the inclusion of a specific company into a sustainability stock index, as we can see here. Or we could focus on another example, which I'd like to show you. We can see that Hartzmark and Sussman found that the introduction of the Morningstar sustainability rating led to significant capital inflows of equity funds who received a high sustainability rating, meaning a rating of 4 or 5 globes, and those funds who received a low rating of only 1 or 2 globes experienced significant outflows, which we can see here. Though these market data approaches allow us to see that investors react, but we do not see which investors and why they react. And this especially applies to the case of individual, so retail investors. And in this case, studies typically are built on survey approaches where you can directly ask investors whether they have sustainable investments or not. But of course, you cannot directly observe these decisions or the decisions of these people. So they might be prone to several biases like the recall bias, or people might purely overstate the amount of investments they have invested in sustainable investments. Another approach might be to conduct stated choice experiments where you ask people to make hypothetical investment decisions. But of course, as I say, these decisions are hypothetical, so they might be prone to the hypothetical bias. And a very nice type of data is a mix of administrative customer data and survey data, like analyzed by Reader and Smates in the Journal of Finance paper. The only drawback of this type of data is that this is not representative for the financial decision maker in general, but for a specific group of customers. And we like to address these issues in our paper and like to propose another type or kind of way to reveal preferences for sustainable investments by conducting an incentivized frame feed experiment with real equity funds among a representative sample of financial decision makers in German households. And to find out which kind of investors invest in these products, we consider a wide array of potential determinants like financial literacy, individual attitudes, and so forth and so forth. Okay, so how did we do this? In the last year, we conducted a survey together with a professional market research institute, and we focused on financial decision makers with a certain knowledge of investment products with variable returns, so stocks, for example. And we got a representative sample with in total 2,500 persons, which was representative in terms of age, gender, and main place of residence at the federal state level. This was the survey structure. We can talk about this maybe in the Q&A session. These are the parts which are included in this specific paper. One important information for you is that we included several treatments for another research question. And for this specific paper here, we only consider the control group containing 749 persons. But this group is still representative in terms of the three characteristics I've told you before. Okay, let's come to the experiment. So very straightforward. This is an example for a typical choice set and the respondents received. And we asked the respondents to allocate 500 euros among 4 different equity funds, which you can see here. And now the question is, how did we incentivize this investment decision? And we informed the participants that we will randomly draw 20 of them after the survey. And for these 20 persons, we would realize the investment decision. That is, in October 2019, we invested the money according to their investment decisions for exactly 1 year. And in the next month, so in October 2020, they will receive the future value of their portfolio. So if the 500 euros increase from 500 to 1,000, for example, they will get 1,000 euros in the next month. And if the portfolio value decreases from 500 to 100 euros, for example, they will receive 100 euros. So this is the main feature of our experiment. We defined or explained the different alternatives by introducing different attributes, which are typically used in these type of experiments, like risk return profile, different fees, past returns. And the main attribute is a sustainability rating, which you can see here. And for this, we used the Morningstar sustainability rating, which I've shown you before in the case of Hartzmark and Sussman. But we did not use the logos, not the globes, but we used the verbal expression ranging from very low to very high for several reasons we can talk about later. And it's important for you to know that for every choice set, we draw these 4 funds randomly from an artificial universe, which contained 8 equity funds. And 4 of them had a high sustainability rating, meaning a rating with 4 or 5 globes. And the other 4 had a low rating with 1 or 2 globes. And we made sure that in each choice set was at least 1 fund with a low rating, so 1 or 2 globes, and 1 fund with a high rating, so 4 or 5 globes. This enabled us to analyze the trade-off between the different levels of sustainability. Okay, let's come to the empirical strategy. This is very straightforward. The main dependent variable is just the amount invested in funds with a high sustainability rating measured in euros. But you might have recognized that some people only saw 1 sustainable fund, and others saw 3, because we did this random sampling. And so people doing a naive diversification strategy would automatically invest more money in sustainable funds if they saw just 3 funds instead of 1. So in order to control for this issue, we additionally considered the difference between the amount invested in sustainable funds and the hypothetical amount they would have invested under the 1/n, so the naive diversification strategy. To explain and find out which types of investors allocate their money to the different funds, we consider a wide range of potential determinants based on previous literature, so financial expectations, environmental attitudes, financial literacy, economic preferences, personality traits, social context variables, and social demographic factors. I can't go into detail now, but this should be fine for this short presentation. Okay, let's come to the main results. So what do we find? The core result is that on average, people invest 286.87 of the 500 euros into funds with a high Morningstar sustainability rating. And this is 52 euros more than they would invest under a naive diversification strategy. So this shows us that people obviously actively select funds with a high sustainability rating. So now you could say maybe it's a design flaw, because it might be the case that these funds have a higher financial performance, and this is why people allocate the money to these funds. And so in the second step, we run a regression controlling for these differences, and you can see the frame here. Even after controlling for financial differences, we find these strong preferences for these funds. So people on average invest 40 euros more into these funds than under naive diversification, even after controlling for financial differences. So this is one of our core results.
Gunnar, you have one.
Yeah, thank you. So if it's not financial performance alone, what is it then? And we can see that it's not, or rather not the financial or the perception. It's, and I just tell about the 3 core factors. It's financial literacy on the one hand, so it's positively related to the amounts invested in sustainable funds. But here it's important to consider the objective measure, not self-assessed financial literacy. This would give us different results. Second, it's the expectation from the social environment. So peer effects play a role. And thirdly, we come to this point here, ecological identification and environmental identification measured by the new environmental paradigm. Minor importance, but also we find some evidence for age, gender, female, and net income measured by a dummy variable, in this case. Okay, just a last summary of our result, or let me say something about the implications. What does it mean when you think about how to mobilize financial decision makers for sustainable investments? This means that it makes sense to disclose information about the environmental impact of these types of investments, or investments in general. This would motivate the people with the environmental ideology. Increasing financial literacy is a very important issue. This is what we see throughout our analysis. So this is really a key driver. And finally, peer groups can play a role. So think about how to, the narrative in certain groups, this might be important. And thus, this might be an interesting avenue for future research. So
Gunnar,
thanks a lot for listening.
Very much. Really appreciate that result. We'll talk more about its implications towards the end, but it clearly reveals what investors are thinking, and their preference for sustainability is not just about performance, but it is actually about the ratings themselves. Let's go on to the second presentation, which is Yasid, talking about the impact of sustainability on retail investor trading behavior, evidence from Germany. And Yasid looks at small investors using a completely different data set. Welcome, Yasid.
Thanks a lot for having me. I will just try to share the screen, and I hope everybody is seeing it. at this point. Okay, so as I said, thanks again for having me and letting me present our paper on behalf of my team. And as you can already suggest from the title, we analyzed the impact of sustainability on retail investor trading behavior. We did so in a German context, so this is what I will present. First of all, to the point why this research might be relevant, I think there has been already a lot said about that, but just as all of you know, sustainable finance is a growingly important topic, and so we're really interested to analyze a subtopic of this growingly important sustainable finance area. And what we really were interested in is, do retail investors, so investors like you and me, or maybe me not already, when I finish my PhD, I will maybe join the group of retail investors. Do those investors care about sustainability? And we wanted to examine this question by really looking at observed behavior. So we wanted to have real order data and real observed behavior in order to causally infer on sustainability behavior. Luckily for us, Börse Stuttgart, which is Europe's largest retail investor exchange, provided us with their full order book, and the exchange Börse Stuttgart is especially designed for retail investors. So just to talk briefly about the research that is maybe most closely related to ours, of course, there's the area of sustainability performance and financial performance, which yields kind of ambiguous results, as there's no clear tendency in literature whether sustainable funds will outperform their non-sustainable peers. The second area here is the one we are more interested in, is also what Gunnar talked about. So when it comes to sustainability preferences, there are a lot of there are some experimental studies that show that individuals do incorporate other factors than just monetary measures in their investment decisions. So this is kind of a really nice finding, and we kind of wanted to transfer this onto real observed order behavior on the stock exchange. And there has been quite some extensive work done in the area of fund flows. So when it comes to fund flows, there's, for example, the interesting finding that investors might be more pardoning to a manager of a sustainable fund than pardoning to a manager of a non-sustainable fund when it comes to lagged negative returns in the past, for example. So they might be less sensitive to lagged negative returns than for a non-sustainable fund when they invest in a sustainable fund. Where's then the research gap we wanted to fill? First of all, really take a look at retail investors.
Sorry, may I interrupt you for a bit? If you are switching between slides, we cannot see the change, so you may wish to go to presentation mode on PowerPoint.
Okay, so you cannot see the change of my slides at the moment, or? I will try to share.
In F5 presentation mode.
Okay. Maybe it works like this. Is it better like this?
Works.
I hope so. Do you see my slides now? Or?
Yes, we see your slide now and we see it changing. So please go ahead.
Okay. So we really took a look at retail investors. So we had no approximation in order to identify retail investors, but we had a real retail investor order book. And further, we examined the German market to go a little bit out of the US market. And I think the most important addition is the fact that we look at it on a stock level basis. So we do not only look at financial performance or approximate the order book with the Lee-Reedy algorithm, which is kind of problematic when you have trades in the spread, but we really have the order book on a stock level basis. So we have orders for Daimler, Allianz, etc., etc. The data we used, first of all, of course, we had ESG scores we took a look at. And the ESG scores we used were the ones of Sustainalytics, as they are publicly available on Yahoo Finance. And Yahoo Finance is quite an important resource when it comes to information for German investors. You might think that this is Wirecard, but in fact it is not. It was Volkswagen 2015, quite a drop here. And the most important part of our data, other than other financial returns and stuff like this, of course, consisted in the order data of Börse Stuttgart. And this order data showed us when, how many buys and sells occurred, which types of orders, etc., and also completed trades. The sample we analyzed, we had to split into two sub-samples, as in the beginning of 2018, MiFID II, which is a regulation in the European context, took place. And afterwards, we did not have a clear, definition of a retail investor anymore, because also market makers were included in our order book, and we did not want this. As you might see, we have to resort to monthly data because of the ESG ratings. And even the German market, with Germany being Europe's largest economy, is not perfectly penetrated when it comes to ESG ratings, which kind of also surprised us. So we have those 47 securities and almost 2,000 stock month observations. And we took a look at demand measures, in this case, for example, the order imbalance, quantifying the fraction of buy and sell quantities for a given month in stock. We applied three major methodologies, but I will take the focus on the difference in differences approach with a panel matching technique, which was recently introduced, as this is our main methodology. Maybe not all of you might know the difference in differences approach. The basic idea is that you have an outcome variable, and in this case, for example, the order imbalance for a given month and stock, and you have a treatment and non-treatment group, and you assume that there had been parallel trends, so the slope for both groups is the same, had there not been a given event. In this case, we have a given event, we would have parallel trends, and so we can estimate the difference in differences, so that's the name, by taking this large vertical red line minus this red smaller vertical line. So this would be the intuitive example. We used a little different approach, as we had time varying treatments for our stocks. So this is a treatment variation plot. And those are the stocks and those are the months. And for example, for an ESG upgrade of 10 points, we have those red squares as treatments. And in order to examine this problem, and because we cannot always guarantee those parallel trends, we had to apply a method that was introduced by Professor Imai and colleagues from Harvard in 2019. And in this method, we take a matching algorithm in order to find the best matching set for each of those red squares and every time point. So we introduce covariates, take treatment history into account, and also select outcome variables in order to weaken some assumptions of the difference in differences approach, and also in order to meaningfully estimate the difference in those two lines, if you want, which is in fact a little more complicated, but I think just to illustrate this makes the point. The treatments we examined were, for once, the fact that you could travel to an ESG long or short portfolio, so to the high or low ESG performance, or also you could be up or downgraded, for example, by a magnitude of 10 points, but we also examined other magnitudes based on the distribution of ESG changes. How did we check whether our matching did work out? So what we did is we checked covariate balance, which just means that for given covariates, we want to achieve a balanced set. So for treatment and non-treatment group, if we look at the difference in the covariates across time for our matching period, which is before a given event always, we want to have a really balanced set, meaning that the covariate balance should be close to zero. Covariate distance and balance should be close to zero. And in this case, this has been conducted successfully.
Yes, you have 1 more minute.
Okay, thank you. So we used quite some measures for matching, for example, Mahalanobis distance, which accounts for non-perpendicular covariates. And but I will not so much go into detail for this. The most important finding is that when a company travels to the ESG long portfolio or short portfolio, the demand following this up or down rate increases and decreases respectively. Which is really interesting is that before the change of a rating at the end of the month, you seem to have some investors that do already process publicly available information during that month, and do during the month before the rating change occurs, increase their demand if an ESG upgrade has taken place. So finally, to conclude, After we completed all of our process, we can say retail investors do take sustainability into account. There are some caveats, some limitations, as this regulation, for example, split our sample and reduced a little bit our treatment time points. And lastly, which is really interesting because Gunnar talked about this, what we cannot do, in our causal inferences, we cannot say why retail investors do increase their demand when an ESG upgrade takes place, whether they have preferences for sustainability or they just suppose that there are better risk profiles during crises, for example, as the errors in expectation hypothesis suggests. So quite some possibilities for further research. Again, thanks a lot. And if you have any questions, do not hesitate to contact me. Sorry for the problem with the change of slides. I don't know where that came from.
Yassi, thank you very much. That was a very interesting presentation looking at the behavior of small investors, overlapping and supporting earlier work by Gunnar. So now we will take it from the micro scale to more of a meso scale, where we have a presentation by Amir entitled Sustainability and Private Wealth Investment Flows. Amir, please come on, and he's going to be showing us capital allocation choices by private wealth banking investors.
Hi, everyone. Can you see my screen? It seems to be flickering.
We can see you, and we can see your screen.
Let me just share that again. Actually, okay. I think this is better. Welcome, everyone. Thanks for having me. It's great to be in this section of the conference. Good thing about being the third person to present is that my predecessors have already set up essentially the motivation of the research and also explained the methodology. So more or less, my job is done here. So this is joint work with Rick Lustermans and Mary Peter-Blum, both from Erasmus University and ABN AMRO, without whom this work would have not been possible. I think they're sitting in the audience, so any difficult questions you have, you can obviously put them in the Q&A or also ask them. Happy to answer them. Great. So as explained, so essentially to motivate this paper again somewhat. So the previous two papers essentially have looked into one particular aspect of sustainable investing, in particular with retail investors, experimental evidence and evidence from kind of trading on exchanges. But here, so essentially, if you think about what has been done in the literature so far, essentially the broader evidence, most work has been done on institutional investors. In particular, there's some studies that look at professional asset managers' portfolios, and they see that they increasingly have allocated more funds to more sustainable firms, and also increasingly engage with these firms on sustainability issues. So in terms of their shareholder voting behavior, and then some others, survey evidence, some of mine and some others have looked at actually the preferences in terms of whether sustainability is important for investment decisions, and at least from survey evidence, institutional investors have responded that they are considering considering ESG in investment decisions. But if you think about kind of private or retail investors' preferences, we don't really know that much other than what you've seen in the previous two papers. Now this new research has come out. So there's some compelling evidence about retail investors considering ESG when they make investment decisions on mutual funds. So and Gunnar has already talked about Hartzman and Sussman's paper in JF that looks at essentially Morningstar ratings for mutual funds. So, but we want to look at what we do is we look at essentially the preferences or the investment behavior of wealthy retail investors. So these are private wealth clients, and where the private wealth clients consider ESG information in their or sustainability ratings in their investment decision, and in particular here, not for mutual funds, but on their individual asset allocations in the individual portfolios. For this, of course, we need access to private wealth portfolios, and we were lucky that one of the largest private wealth banks or private banks, ABN AMRO, allowed us to access the data on an anonymous basis. So if I cut out, or if my internet connection breaks down, or essentially the main takeaway you see here on the picture on the right is these are essentially a summary of our results, is that over our time period, so between 2016 and end of 2019, you see essentially larger investment flows of private investors into assets with higher sustainability rating. So here, rating 5 are the higher rating, compared to and outflows into those with low sustainability rating compared to a medium sustainability rating. By the way, if my slides are too small, there are arrows on the top right of the slide screen, so you can enlarge them if necessary. And feel free to put questions in the Q&A. So as mentioned, the data is essentially anonymized investment holdings of private banking clients from 2016 to 2019. And we have data on equities and bonds. This includes corporate as well as sovereign bonds. Essentially roughly 100,000 plus clients, 200 billion in assets under management, of which we capture, once we clean up the data, around 120 billion. This includes ABN's clients from the Netherlands, Germany, Belgium, and France. And this cross-country variation is important because generally, there are some unique features of the data which essentially makes our life easier to exploit certain variation and try to get to a causal relationship between sustainability ratings and fund flows. So first, we have different types of clients, and in particular, there's advisory clients and execution-only, so-called execution-only clients. The advisory clients having access to advisors, and with that receive essentially regular portfolio updates and reporting, including reporting on the sustainability ratings of their assets, which execution-only clients do not. So essentially, we can then hold essentially countries and other characteristics fixed, but have variation in the reporting of the sustainability ratings. The same is true when we look at cross-country variation. So for historic reasons and how the bank is structured, is the reporting varies across countries. So the portfolio reporting for the clients in that, for example, in the Netherlands, clients receive more regular updates on the sustainability ratings, whereas in Germany, less regular, and then in France, they do not receive regular updates on the sustainability ratings, and we can use this variation. But more importantly, there's another quirk in the data that we can essentially exploit. And this is this quasi-natural experiment that I'm going to explain in a second, that essentially induces an exogenous change in the salience of the sustainability ratings for the underlying assets that the investors hold. So let me explain a little more the research design. So general baseline regression is essentially a panel regression where we look at flows, so investment flows into the assets by different client types across different countries, across time, and look at the different ratings from a sustainability rating of 1, so low, to 5 high, the omitted category here being a rating of 3, controlling for various fixed effects. But now, as I said, we explored this quasi-natural experiment, and here in essentially similar to what you've seen presented on a difference in difference, we do a triple difference here. And in particular, the reason why we do this is, so what happened is that the bank changed its ratings provider. its sustainability ratings provider pretty much halfway through our sample period, which then increased the availability of sustainability ratings for the underlying universe of the assets that the clients had available to them. So which means now, for certain assets for which
Amir,
no sustainability
Amir, you
rating.
have 2 minutes. I'm giving you a little bit of an earlier warning so you can get to results.
Will do. Thank you. Thank you. The results are quick. So essentially, so that we have now assets that had no sustainability ratings that now have a sustainability rating available, and we can control for the sustainability rating level by looking at assets, the control group that always had sustainability ratings. So we have essentially a treatment group with a shock, and then we use an event study to look at changes in sustainability ratings. So let me show you some results here. So our panel regression results essentially show you that that we have significantly larger flows to assets, so on average over the sample period, to assets with a high sustainability rating compared to those with a low sustainability rating, and that difference is significant. It's and economically, it's roughly 58 million per month, which over the whole sample period is around 2.5 billion in incremental flows, investments into higher sustainable assets. We do this, we try to essentially address kind of firm characteristic differences by looking at a propensity score matched sample and find essentially these larger differences, and in particular for advisory clients and not for execution only clients who do not see or have access to these reports that show them the sustainability rating. So which gives us more confidence that these flows are due to the salience of the sustainability rating. But more importantly, this triple difference regression, where we now have essentially the treatment firms, those that in 2018 now have their sustainability rating shown. We look at then the ratings of those, so high, so rating 5 and 4 compared to rating 1 and 2 versus low, and compare those, so difference out the firm differences with those that always had their sustainability ratings, and we find significant differences in flows. And then event study, looking at changes, we find similar differences only for advisory clients that essentially have a view on the sustainability ratings reports. So before I overrun, so essentially we
let the next speaker go, but why don't you sum up in 10 seconds and then we'll
I'll sum up. So main results essentially show a significantly larger investment flows into assets with high sustainability rating, and this is economically significant. And essentially through our research design, we try to get to a plausibly causal relationship between the ratings and the flows, and hopefully have provided some evidence for essentially, or first evidence on private wealth investors that they care about these sustainability ratings. Thanks very much, and I look forward to the questions in the chat.
Thank you, Amir. So, you know, what's really important here also is that Amir's research looks at the investors who are not using the private bank for asset management choices, but simply to get information and use it for execution. So they're making their own decentralized decisions. And so Amir's result very much echoes the results of Gunnar and Yasid. And now we'll go to the macro level, which is basically a paper by Arjan entitled Carbon Intensity and the Cost of Equity Capital. So let's look at the market-wide impacts on issuers of all the results that we've seen so far. Welcome, Arjan.
Thanks a lot. Can you let me know if you cannot see my screen now?
We can hear you. We cannot see the screen yet. I see the screen now.
Okay. Well, thanks a lot also to the previous presenters for this very interesting work. So the previous three presentations have focused on ESG ratings mostly. And in this paper, we look at a specific ESG component, namely the carbon intensity of firms. And we want to investigate in this paper empirically how the carbon intensity of firms impacts their cost of equity capital. So this is joint work with Professor Ibe Kuhnle, Mulder and Scholtens. And the main question we aim to address in this paper is whether capital markets penalize high carbon firms, or put it differently, if investors require a premium for investing in higher carbon, relatively high carbon assets, meaning a higher cost of capital for these more polluting firms. And why might that be the case? So there are two main economic mechanisms at play. So first of all, there is this issue of regulatory risk, or carbon risk, if you will. So it's increasingly clear that regulation, carbon regulation, climate policies have to be intensified in the near future to reach climate goals. So on a national level, but also even more so at an international level. If you look at the Paris goals and have a look at the emission gap report, for instance, you immediately recognize that much more has to be done in terms of policy interventions. So this poses a real potential threat, if you will, to companies, and poses a financial risk. So this might induce investors to require a premium for investing in higher carbon firms. The second mechanism is the role of social norms. That might play a role. In that respect, there is increasing attention for divestment practices. So high carbon firms are being avoided by investors, not only because of financial considerations, but also because of some kind of social preferences, which might actually change the cost of capital of these firms. So in this paper, we investigate the premium, whether there is one and how big it is, of firms' carbon intensity. I think there are a couple of contributions of this paper. So it sheds some new light on the market incentives which are currently in place for low carbon investments. We, as I previously also said, we look not at ESG ratings, which are more aggregate, but specifically look at the carbon emissions of firms and look at this measure of carbon intensity. So linking carbon emissions to their production activities. And with carbon intensity, there are two clear mechanisms which can play a role and which we empirically test. So first of all, there's this divestment or social norms effect, which are non-systematic factors. And we want to test whether these factors can be observed in our sample period. And a second mechanism is the notion of systematic risk. So, as I mentioned, the threat of regulation, intensified regulation, and market risks related to the energy transition can increase the systematic risk profile of firms and therefore impact their cost of capital. So these are two main mechanisms which we want to evaluate. And we do so using data from two major data providers of carbon emissions data, Asset4 and the Carbon Disclosure Project. And so this is an extensive panel data set of about 1,900 firms. In terms of methods, we first want to test whether this taste or divestment effect can be observed. So whether we see a premium which is not related to conventional systematic risk factors. So if there is any effects of social preferences or tastes, then we should see a significant premium on high carbon intensity assets, which cannot be explained by systematic risk factors. So we employ this long-short portfolio approach to test that. And secondly, we study the potential impact through the systematic risk channel. And we employ panel regression techniques to investigate that relationship. So on the left-hand side, we have the CAPM-based cost of equity capital, so based on systematic risk levels. And the main independent variable here is the carbon intensity of firms. So moving to the results, regarding the first taste mechanism, we find no indication that such a taste mechanism plays any role in our study periods, in our sample. So we should have observed, if such a taste effect would be present, we should have observed positive alphas on these long-short portfolios. And there's even slightly negative, some indication of negative alphas. So meaning that we find no evidence for a return premium, which cannot be explained by systematic risk factors. So basically all return differences can perfectly be explained by conventional systematic risk factors. That leads us to dive deeper into the second possibility, that second mechanism of systematic risk. There we employ panel regression techniques with the main dependent variable being the CAPM-based cost of equity. And our results here clearly show that carbon intensity has a positive impact on the cost of equity, so through its impact on systematic risk levels. So and this result is robust to a wide variety of robustness checks. And for time reasons, I will not go over all the different robustness checks we performed. It's quite a long list, but this statistically significant result upholds. If you look at economic significance, however, we can say that the results are quite modest. And so the effect of carbon intensity on the company's cost of equity is quite small. So if you look at the interpretation, one standard deviation increase in the carbon intensity means about 6 to 9 basis points higher cost of equity capital. And to give it a more feeling of these results. So if you look at the average firm, compare it with a firm with a twice as carbon intensive production process, you see a 1% cost of equity premium or 3 basis points. So that's a quite modest effect, you can say. So I'll skip to the conclusion to leave some room for discussion. So our main conclusion is that the carbon emissions profile and the carbon intensity affects systematic risk of firms and thereby the cost of equity capital. So no evidence for some kind of taste effect, but also the effects are quite modest. So given these modest results, we have several implications we think of for practitioners. I think it's clear that decarbonization is relevant for investment decisions, just as the ESG ratings are. This research shows that it's a more specific issue of carbon intensity, and the mechanisms are also a bit clearer, that this is a relevant investment issue. So for research, there are also maybe evident for you also, the implications for future research. What I'm particularly interested in is your views, maybe for the Q&A or later in the discussion, what role there is for policymakers, given that there's only a very weak impact we can observe in capital markets of this crucial environmental factor of carbon emissions. So it's only very weakly being incorporated in capital markets.
Thanks, Arjan.
Yeah,
I
want to thank you for your attention and happy to discuss further.
Yeah, no. So listen, I think what's very interesting about Arjan's work is that he finds a statistically significant but economically insignificant effect. But also what we have to keep in mind is he's looking, of course, at carbon intensity alone and not ESG more broadly. The economic significance of ESG more broadly, that includes KPIs on carbon intensity, is larger. So that's probably not surprising. I see a whole bunch of questions in the Q&A. So we have about 5 minutes, and I do want to ask a couple of them and give you guys a chance to respond. So maybe if you could all put on your mics and cams, then I think we'll be able to see you all at once. And thank you very much. So I think, what's interesting about this is that the little guys, the small investors, the mesoscale investors that are making their own decentralized decisions, they clearly care about this, and they clearly care about this whether or not it shows immediate financial return. But we're not seeing it yet in large measure in the cost of equity capital. So do you have any views on why that might be? Is it possible that the discussion about carbon is relatively new? And so we haven't seen it in the data, which goes back a few years. Anybody?
Yeah, maybe if I can respond, I think something might also have to do with data quality and availability. So carbon emissions data might not be incorporated that much or looked at that much due to poor access to this data, or I'm
not sure that we would.
Data quality.
If you think about all the ESG KPIs out there, probably the one with the best data quality is the one on carbon emissions KPI. And you're looking at scope 1 emissions, not even scope 2 or 3. So I'm not sure that data quality would be an issue here. I could throw out a grenade into the discussion as we end, which is that perhaps the small investors really do care about this, but they're not large enough to affect it, because we have the behemoths of the world, the large passive investors that say they care about ESG, who are not actually allocating their capital. And so that you're not seeing the result at the cost of equity level, because there's a lot of greenwashing and grandstanding amongst the large investors, whereas the small investors who are able to make their choices and actually make decisions are moving their capital towards high sustainability ratings. There's a question in there, your result, Yassid had a result that some investors seem to anticipate ratings changes before those ratings happen. Is this an evidence of the wisdom of crowds? Sort of like that old paper by Richard Roll, which showed that the price of frozen orange juice futures in Florida moved before the National Weather Service predicted frost. Anybody want to jump in?
Oh, sorry. Yes.
No, sorry.
Yes. No, I just wanted to refer to the idea that in Germany, several individual investors do not really have the awareness of these type of investments and do not have the correct or the support from bank advisors, for example. Yeah, so this is still in its infancy. So a lot of people working at banks did not learn about how to promote these type of products and don't have the education. This is really an issue. And this is what we also show in another paper. So information and how to handle all the information in different ratings and so forth. Thinking about transparency and etc.
That's interesting, Gunnar, that you point out the issue of the lack of information, especially amongst professional investors. I think the story that this panel is telling us is that the small investors, perhaps the ones that are less formally educated, are the ones that are making the moves towards sustainability in their capital allocation choices. Much the same way, I think the parallel we see in the universities and the business schools are that the students are the ones who are driving the interest in research on sustainability, and that the old guys like us with the gray hair, my hair would be whiter, I just dye some of it gray. But the old guys are the ones that haven't got the training and the desire to move our resources towards capital allocation, towards higher sustainability issues. Amir, what do you think? You haven't said anything.
Well, yeah, I can say plenty. Two things, I think. So first on the issue of why we don't see that in the cost of capital and maybe even in prices, I'm actually not so sure. So one is, as you mentioned, the question is who is the marginal investor here, right? So who's moving? And I think in our paper, we say, well, yes, so we have wealthy individuals, right? So, and they have been shown to have essentially a larger share of or portfolio share in markets, right, than the smaller retail investors, as you say. So I think you're right then that it's not enough that only a percentage of the retail investors are invested in sustainable assets. It has to be obviously the marginal investor would affect the cost of capital. So, and I think there's, as Gunnar said, as I think Arjen said, there's estimation error, of course, right? So it has to be a big effect to be able to measure that on that scale. In terms of the anticipation effect, I think if you look, you could think about this as we are measuring sustainability with ratings, right? And then the question is, when do the ratings agencies change their ratings given the information out there, right? So it's similar with the credit ratings, right? So do investors actually anticipate some of the changes in the ESG ratings given what is happening in the news on those firms? And I think as we get to more real-time data on ESG behavior of the firms, we'll also see that there's a relationship real-time compared to essentially these ratings providers that obviously change them at fixed intervals. So I think there's something to be said.
Okay. Yeah, no, I think that's clear. I think, what you guys show is that the decentralized decision makers, when they have available that information, ideally when it's available with low measurement error, they clearly make choices to direct capital towards more sustainable investments. So, obviously ESG matters to investors. It matters to small investors, large investors. In terms of a policy recommendation, I'm going to give each of you 20 seconds to tell me, what we should be doing. Does this, for example, mean that we have to have more enabling infrastructure and sustainability reporting and disclosure for retail and small and private wealth investors? So, Yasid, what's the short policy recommendation you'd have?
I think it's just what you just said. So even we as researchers, with all the databases we had, and also when I was at the Technical University of Karlsruhe, which has a lot of connections to the industry for energy and carbon data, even we often struggled in order to assess sustainability. And as you've seen, often in Germany over the years, during the last years, the spectrum of shares has been inclining that have been rated even by Sustainalytics, a major market participant. And, I think that this information infrastructure has to be a lot better, because it.
Okay, so sorry, yes,
Yeah,
30 seconds,
what I
but
want
great
to say.
idea. Increased coverage of disclosure. Gunnar?
Same point, and I appreciate the effort at the European level with the technical expert group on sustainable investments and working on a taxonomy in order to make it easier for also individual investors to understand what's going on there.
Okay, thanks, Gunnar. Arjan, your 30-second intervention.
Yeah, okay. So yeah, disclosure, both in scope and quality, I think is key. And I think if you look at the current incentives being in place in capital markets to address climate as a topic, then maybe if capital markets don't provide themselves incentives, maybe to regulate capital markets in a way, or to look at maybe public financing opportunities for projects which don't seem financially attractive currently in the markets.
That's great, Arjan. So we have to do disclosure, but also have to move to regulation and public investment. Amir?
Quick one just to add, given that we see that essentially investment flows react to these ratings, I think there's also something to be said around educating investors around what these ratings actually mean and what they measure. Because some of these ratings, as we have seen in recent scandals, don't really measure what they're supposed to measure. And this goes back to the standardization and taxonomy, I think, where we need a bit more development.
Absolutely. Amir, that's a great point. More education, better education. And the good thing is that the five of us are in academia, and that's something we can actually do something about. We have no excuses. On that note, we're 7 minutes over time. Really appreciate everyone's patience listening to this very interesting research. Look forward to continuing the discussion outside of this room. Take care, everybody.
Thank you, everyone.
Thanks a lot.
Bye.